What is going on, guys, and welcome back to another very exciting video. In this video, we're going to be taking a look at a brand new holding within the portfolio that I just added this past week, and that is PayPal. PayPal is down in a massive way over the last couple of years. So what we're going to do in this video is we are going to take a look at why the stock is down so much. We're going to take a look at what is going on with PayPal's numbers and how they are starting to turn around and actually look very, very positive going forward. And then we're going to leave off by taking a look at their valuation and where the stock price could trade in the next couple of years. So if you enjoyed the video, make sure you drop a like down below, and if you want to see more videos like this one, make sure you hit that sub button. Let's start off by taking a look at their stock chart. We can see that they are down 23.64% over the last 5 years. What that means is back in 2018, they were trading at almost $81. Now they are trading at $61.69. And if we go to their all-time highs, we can see that they were trading around $310. And from there, the stock is down around 80%. So there are a few reasons why this stock is down in such a major way. The first being one, that we are coming out of the pandemic. Obviously, a lot has changed over the last couple of years. PayPal is a company that saw a tremendous amount of growth going into the pandemic as a lot of people began to shop online, and that really helped support the business. But now as people are getting out and shopping in retail stores, going out and actually being able to go into stores and purchase things, that is obviously going to have an effect on PayPal's business and slow down some of their growth. Another big reason why PayPal has fallen so much over the last couple of years is that they have lost their partnership with eBay, and they've only lost part of the partnership. Buyers can still use PayPal to buy goods on eBay, and they are still receiving transaction fees from that side of the business. However, in the past, sellers on eBay would receive their payments into PayPal accounts, and PayPal was obviously brokering that transaction, so they were receiving a fee from that. That is no longer the case. eBay is now paying sellers directly to their bank accounts, and obviously that is taking away a little bit of PayPal's transaction fees that they were previously receiving. So the main reason for the decline in the stock price, it really comes down to financial performance. And this article was posted a year ago, so keep that in mind. We're going to look at their more recent results here next. But a year ago, we were seeing margins decline year over year from 17.3% down to 11%. We saw net income decline 54% to $509 million versus $1.1 billion. And we saw earnings per diluted share fall 53% to 43 cents versus 92 cents. One thing they started doing last summer is actually announcing job cuts. So this is expected to help the company in the long run, but over the short term, they're expecting around $20 million in restructuring costs for the first 3 months of 2022. Then they're expecting another $100 million more in restructuring charges for the rest of the year. They're expecting that this will save them around $260 million in employee-related costs. So overall, this will help the business in the long term. Just over the short term, there's going to be some pain that has to do with the costs that they are going to incur over 2022. So now that we're in 2023, we're starting to see those numbers really change. And that's what we're going to dive into here next. So obviously those numbers we just took a look at were very bleak. We saw operating margins falling by around 6%. We saw EPS numbers falling by around 50%. We saw another 50% decline in operating income. So those numbers were all from a year ago. They were from June of 2022. Here we have the numbers for PayPal for May 8th of 2023. So their most recent earnings announcement. When it comes to a company like PayPal, their most important number is their total payment volume. So their total payment volume right now is sitting at $354.5 billion. That's growing at around 10%. Their net revenue came in at $7.04 billion. That's growing around 9%. We have GAAP operating income of $1 billion, growing 41%. We can see non-GAAP operating income of $1.6 billion. That's growing at 19%. When we look at their GAAP EPS, it came in at 70 cents per share. That's compared to 43 cents per share in Q1 of 2022. That is a growth number of 61%. Their non-GAAP EPS came in at $1.17 compared to 2022, where it was 88 cents. That is a growth of 33% year over year. And their operating cash flow is sitting at $1.2 billion, and their free cash flow is sitting at $1 billion. So overall, when we compare those numbers to 2022, we could see that there's a fairly decent amount of growth there. We'll take a look at these graphically as well, and you'll get a lot better picture of what's going on with the company. But what I want to jump into, and what is more important, is what is going on with their guidance for the rest of the fiscal year. So we can see that for Q2, they're expecting growth of around 6.5 to 7%. They have an EPS number expected for GAAP earnings of 81 to 83 cents. They have non-GAAP EPS expected to grow 24 to 26% to $1.15 to $1.17. cents. And then they also are expecting their fiscal year, entire year, to come in around $3.42. That's compared to their fiscal year of 2022, where it was only $2.09. And they're now expecting their non-GAAP EPS to come in at a growth of 20% to $4.95. So we are seeing overall a lot of great growth numbers for their EPS, for their revenue. And on top of that, they're expected to repurchase around $4 billion worth of their shares. And honestly, their numbers just get more impressive when you look at them graphically. Here we're looking at their revenue, and this goes all the way back to 2015. And the first thing I wanted to point out is all of the green down here. What this is representing is their year-over-year change in their revenue. So we can see that every year since 2015, their revenue numbers have continued to grow. What we saw back in the pandemic is that a lot of payments were coming through online as people were being forced to stay at home, and they experienced at one point a 30% year-over-year growth in revenue. So absolutely huge growth there. However, since then, the growth has slowed. But what's important to keep in mind is these numbers are still growing. They have not seen a year-over-year change where they have seen a decline in revenue. They have just slowed down to around, 5% at some of these low levels. I'm kind of anticipating that they'll get somewhere back to where they were pre-pandemic, maybe in that 10 to 15% growth rate for the revenue numbers. EPS is where we have seen some pain. So we could see back at their kind of all-time highs, they had an EPS trailing 12 months of $4.39 at their peak. Since then, we have seen a decline in EPS numbers all the way down to around $1.74. We could see that quarter, they actually announced their only negative quarterly number over the last 10 or so years, and it came in at a loss of 29 cents. So that obviously affected the stock in a very massive way. But when we look at their quarterly numbers compared to kind of their 2019 numbers, or even back to their 2018 numbers, we can see that they were only bringing in around 40 cents or so, 40 to 50 cents in EPS. Now they are about double that. So they are bringing in on a quarterly basis around 70 cents per quarter. And what that comes down to is the stock is actually trading 20% lower than when they were bringing in half as much EPS. So this is absolutely insane when you really think about the business and the business numbers that are going on, right? They are bringing in twice as much money, but the stock is trading 20% lower. So that is a clear discrepancy with how the business is performing and how the stock is performing. Another thing to keep in mind for EPS is their shares outstanding. So here we could see that their shares outstanding over the last year has declined around 2.5% quarter over quarter, and most recently it's declined 3.24% over the last quarter. So this is absolutely massive. This is something that they've already announced that they're going to do over the next year. They announced $4 billion in share repurchases. And what that ends up doing is it increases your EPS number, because EPS stands for earnings per share. So if you have more earnings with less shares outstanding, that means your EPS number is going to go up. And this is super, super important, because what it's going to come down to is what we're going to look at next, and that is valuation. And when it comes down to valuation for PayPal, they are trading at an extremely low forward P ratio. We can see that right now it's sitting around 13.48. As of around a year ago, they were trading around an 18 forward P ratio, and we could see a little bit over a year ago, they were trading around a 25 forward P ratio. And if you compare that to one of their competitors, Square, we could see that they're trading at a forward P ratio of around 35 to 40. Personally, I think a better comp is a company more like Visa, and Visa is trading at a forward P ratio of anywhere from around 20 to all the way up to 31 forward P ratio. Currently, it's trading around a 26, 27 forward PE. So before we calculate where their PE and where their valuation could be headed, let's take a look at their EPS based off what analysts are expecting. So we have 41 analysts covering the stock for 2023. They have an average estimate for EPS coming in at $4.95. They have a low estimate of $4.78, and then a high estimate of $5.05. So what we can do with those EPS projections is we can plug them in and come up with, based off the current price, where the PE ratio is sitting at right now. So we have the $4.78 number, and then we have the $5.05 number. And we can really see that basically no matter where they come in with their EPS, the analysts are projecting that they'll be at a forward PE ratio of 12.22 to 12.91. So what I've done here is I've been fairly conservative. I've put in numbers of 20 to 25 for a forward PE ratio. What we saw again from Visa was around 27, and Square was all the way up in the 30s. So I really want to see PayPal trade back within where the market is trading, which is anywhere from a 20 to 25 forward PE. So if PayPal were to trade trade back up to a 20 forward P ratio, we would actually see the stock price increase to around $99. That would be a 60% increase from the current share price. And then if it were to trade all the way up to a 25 forward P ratio, we would see the stock price increase to $123.75, which would be a 100% gain from the current share price. And that is for the average estimate for earnings for this year. When we look at the other two estimates, we could see how those numbers would change slightly, but really no difference, again, just because the forward PE ratio currently is sitting around the same number. So there's a very tight projection for these EPS numbers, and that really keeps all of these numbers relatively close. We could see that the range is really anywhere from 54% gain all the way up to 105% gain. So obviously keep in mind, those are only projections based off previous PE ratios that we've seen from the market, as well as some of their competitors. There is no guarantee that the stock will go back up to those prices. But when you look at PayPal and you look at the business and how it has changed over the last 5 years, it is crazy to think about the fact that they are trading lower than where they were 5 years ago. We can also look even their pre-pandemic levels. They were trading around that $120 mark that we saw from the projections. So I don't think it is out of the realm of possibility for the stock to move back up there. I think it is obviously going to take some time for the investor base to adjust. I think we saw a lot of investors over the last couple of years get into PayPal for the massive amounts of growth. And when the growth slowed down and stalled out, I think a lot of those investors ended up bailing out of the company. So I think what we're going to see is a lot of value investors getting back into this company. And I think that is the investor base that is going to help this company grow back up to maybe the 150 stock price range. I think that is definitely possible. So again, keep in mind, this is all my opinion. I do love this company. Looking at it, these numbers are absolutely insane. And I'm hoping to add more over the next month or so and really build out a position in PayPal. So I hope you enjoyed the video. Do not buy a stock just because some random guy on YouTube talked about it. Make sure you are doing your own research and looking into these companies on your own and making sure they fit your risk tolerance as well as your time horizon. So with all of that said, I hope you enjoyed the video. If you did, make sure you drop a like down below. And if you want to see more videos like this one, make sure you hit that sub button. And as always, guys, have a wonderful rest of your day.